Hi, I'm Hong Chen. Today I'm going to introduce the week 7 topic, which is about risk management and insurance. This week lecture focuses on how risk works in personal finance and how insurance can be used as a tool to manage that risk. The slides set out our for learning objectives, and they cover the concept of risk, pure risk, risk pooling, the risk management process, life insurance, health insurance, and general insurance. The key starting point is this slide is that the key the idea risk means uncertainty, and when an outcome is uncertain, risk exists. The lecture is about explains actual outcomes may not equal expected outcomes. Expected value is a probability weighted average of possible outcomes. This helps us understand that two situations could have the same expected value but very different levels of risk. The spread of possible outcomes matters, not just the average. Um, this also talks about pure risk, and it means there is only downside and no upside. Examples include premature death, illness, injury, and medical costs, damage to property such as a home or car. This is very important in personal financial planning because many major financial losses come from pure risks rather than from investment choices. Another important point is about fair premium. The lecture explains the fair premium is an amount a risk neutral person would pay to eliminate risk. So the idea helps to show why people are willing to pay for insurance. Insurance removes uncertainty, it gives financial protection and peace of mind. A lecture also explains the personal risk management process. The process has 5 parts, like risk identification, risk evaluation, risk control, financing the strategy, and the review. This means the person needs to identify what risks exist, estimate how serious they are, and decide how to reduce them, decide whether to return or transfer them, and keep reviewing the plan over time. The slides also show like 4 broad risk responses. A person mitigate the risk, eliminate it, accept it, or transfer it. So mitigation means reducing the chance or impact or lose. Elimination means leaving the risk situation completely. So acceptance means keeping the risk and using your own savings to cover possible losses. Transfer means using insurance to shift the financial loss to another party in exchange for a premium. A major concept in insurance is risk pooling. The lecturer defines risk pooling as grouping individuals together to share risks and to help determine premiums. And the house burglary exam also shows how a group can contribute to a central pool, and so that the loss of one member can be covered by the many. This is the basic economic logic and behind the insurance. The slides also explain insurance policies rely on utmost good faith. This means both sides need to act honestly and fairly. Applicants must disclose material facts that can affect the insurer's decision. If information is incorrect in a material way, the insurer may reduce the payout or deny the claim. So Mainly main takeaway from the lecture is that risk management is not just about buying insurance, it's about underlying certainty, deciding which risks matter most, and choosing the right response. Insurance becomes valuable when a possible loss is large enough to seriously damage a person or family's financial position. Thank you.